We're going live!
Woo!
So as you lovely attendees start joining this amazing, super duper awesome webinar hosted to you by Fixated on Real Estate and myself, Mr. Tarl Yarber with Fixated Real Estate. I am so excited to have these panels today. These gentlemen are masters of, what are you masters of? No, you're masters of funding, raising capital, financing, all that great stuff. And in fact, this is actually something Jay knows a thing about or two as well, which is surprising because usually he's the odd man out, right? But every single time we do one of these, Jay's like, what are you guys talking about? No, I'm joking. Jay's actually an expert in so many things, which is why he is always a guest and needs to figure out how to use this video as well on our call here. So today's topic is funding and raising capital in today's market. So one of the challenges in today's market has been, if you guys remember March and April, which we'll talk about, funding went away, right? Nobody can buy a house. And now all of a sudden funding's everywhere again. So let's discuss that today and dive deep into that. Let's also introduce our awesome super duper panelists for today on Fixated on Real Estate's Experts Live. I'm going to start with Jay this time. We always leave him last. So I'm going to start with Jay because Jay is our returning champion every single week. So Mr. Jay Scott is CEO of 123 Flip and also author of every Bigger Pockets book ever written. He is an entrepreneur, technologist, investor, and advisor, host of the Bigger Pockets Business Podcast, author of 4 Bigger Pockets books, including the book on flipping houses, the book on estimating rehab costs. That is one of my favorite books, actually, Bigger Pockets has ever posted. The book on negotiating real estate, and the book on recession-proof investing. He's a real estate investor that's completed over 400 deals since 2008. And he also just, how many units? 150 units or whatever in Houston, or just completed his capital raise for 8 million. How much?
Yeah, eight and a half.
$8.5 million. We'll talk about that later, about raising $8.5 million to be able to close on the deal in Houston that did not get knocked down by the hurricane. So, which is good. So that's a bonus, especially when you're in escrow. So that's it. We'll jump into that later. I also want to introduce my good friend, Mr. F.O.R.E with Rain City Capital. F.O.R.E is the founder and president of Rain City Capital, has over a decade of experience in the alternative finance industry. Since 2009, Rain City has funded over $450 million in loans in over 3,500 transactions. In 2016, F.O.R.E was named Puget Sound Business Journal's 40 under 40 list. You're under 40?
I am under 40.
I'm joking, yeah, I know.
Just barely.
Barely. F.O.R.E was born and raised in the Seattle area and lives in Woodinville with his wife and 2 children. Give it up to F.O.R.E. Woo!
Dude, that bio is old because we're over $1 billion, but I don't mean to brag.
Yeah, it's no big deal. Right? It is an old bio, and it's because that's the one we have for you. So let's get that updated, Fred.
Yes, sir.
And we got Shreyas, without the S. Shreyas Vijaykumar. Shreyas is co-founder of Certain Lending, which he started with Charles McKinney in 2017. Prior to Certain Lending, Shreyas was an engineering major at Palantir Technologies, a Silicon Valley data analytics company that worked with several large U.S. financial institutions to manage credit losses after the housing crisis. Shreyas started his career as a product manager on the Visual Studio team at Microsoft. Outside of Certain, Shreyas is an active startup investor and advisor, right? And you guys have raised some capital over the years, right?
Yeah, we have. Yeah, thanks for having me, Carl.
Awesome. Can't wait to talk. So today, as we said already, we're going to talk about raising capital and funding in today's market. But before we do that, I'd love to touch base on, if you guys are watching this, especially if you're newer investors, you might not realize what really happened back in March and April earlier this year and leading into even May, depending on where you're looking at, where the capital markets and funding almost just stopped completely, especially for real estate investors that deal with like fix and flips, multifamily, commercial. It became very, very confusing of where we were going to get our funding. And there's quite a few people out there that had their funding pulled, or it got delayed, or they had to scramble, or the terms changed on them out of nowhere. And it made a lot of us panic a little bit. For those of you guys that don't know what happened, I'd love to spend a few minutes going into that before we jump into what's going on today. So out of the gentlemen here, Fred, Shreyas, or Jay, which one do you guys want to tackle, at least a brief introduction of what happened back in March and April?
I think the easiest way to describe it is, well, for those of us who've been around and, got their ass handed to us in 2008, there was a giant unraveling of debt, right? And for me, and I think along with, most of the larger banks and, everybody else up and down the gamut, we're like, well, I'm going to go to my garage. I'm going to pull out my 2008 playbook. I'm going to go to the part where like, hey, this is how you don't lose money. I'm going to do that. And so that's exactly what they did. They said, look, man, this whole virus thing, this is crazy. We have no idea what's going to happen. And, like we as speculators, we make loans, we buy houses, we flip stuff. And when we don't really have a certainty of what's going to happen, I mean, who knew? The market could have gone up like it has. The market could have died by 30% in 6 months because people were dying off. Like, no one really knew what was going to happen. And so they did. They just took out the 2008 playbook and said, man, how to not lose money. Okay, that's what I would have done in 2008. And so everybody did it across the board, myself included.
Shreyas?
Yeah, I totally agree with all that. Just I was looking back at dates, so to throw a couple in, because people probably don't remember, it's been 6 months, like how quickly this all happened. Early February markets were doing extremely well, credit markets, equity markets. February 20th was the first date that you saw a major downturn. So that's probably the earliest that, someone would have started to see impact to financings in flight. If someone had experienced anything earlier than that, that would have been a little bit surprising. Quote unquote Black Monday was March 9th, where markets basically fell 9% in North America. And then there was a little rally, and then they fell again on the 12th, which was like a Black Thursday, recovered a little bit on the 13th. And then Monday, the 16th, I remember coming into the office and just going like, I've never experienced something like this in my career. The Bay Area did a shelter in place that day. I think California was the first state to have one. And it was, so it basically like over a span of about 2 weeks, it went from like markets have never been better to like, get everything out from under your mattress. So I just want to highlight like how quickly it hit really everyone.
Yeah, and then you're in the Bay Area, so you're in San Francisco. For those of you guys on the East Coast, the Bay Area, San Francisco, so you're there. So you're also experiencing the shelter in place in the heart of it, and one of the first places to do it. Seattle, we're like, what's going on, right? So where we are, and so we're seeing that in the market. But I also just remember that time period getting phone calls because a lot of my close friends are all lenders or people that raise capital and finance, and everybody's just going like, what do you do? What do you think we should do? Should we pull out? Should we do this? And I know that can you talk a little bit about the secondary market and how, just so a touch base for those of you guys listening that especially newer, when you deal with, let's talk about hard money or even a portfolio, actually all portfolio lenders keep their loans, never mind. Most of them do at least. But a hard money lender, a traditional hard money lender, let's go to finance a fix and flip or a really shitty house of some category, whatever it might be. Most of those people don't keep those loans in-house, right? The majority of them. And so what do they typically do with those loans once they fund them? And then what happened to that market, especially for the hard money lending side afterwards, and especially in that 2-week period?
Yeah, I mean, just briefly to touch on that, like I was talking about the equity markets, but they deeply reverberate into the credit markets. And I think the first thing that happened was like the agency mortgage market basically seized up because people pulled money out and just didn't want to invest in those long-term assets. I think pretty much every long-term loan is held in some sort of, securitization, or it's like, because you don't want to own a loan for 30 years. You want to be able to get in and out of it depending on what your investment strategy is. So there's a whole capital markets infrastructure that exists to allow primary lenders to make loans to you and then package those and then sell them out. And if that market to put them together and sell them out goes away, it's like if you get kicked by someone and then that forces you to kick someone and then that forces you to kick someone else. And so this is basically what the Fed tries to stop by saying, well, if we can just stop the first person from kicking the second person, then the second person doesn't have to kick the third person. But in this case, it was just really hard because it was so sudden. And yeah.
Because I remember like there's quite a few hard money lenders out there that they sell their loans to other investment bankers and so forth, or whatever it might be, whatever that term is. And I remember a number of those people just say, we're not buying loans anymore. And then if you had a big book of business as a hard money lender and you planned on selling all those loans and you couldn't, and what are there any lenders out there that actually like are still recovering from that time period?
Oh yeah, there's plenty of lenders. I've talked to a few that really just got stuck with loans that they had never had any intention of actually keeping on their books. And a lot of people were just really like recycling cash. It's like, as a hard money lender, if you got, it's like when I started, I had very little money and I had to build my own secondary market until this whole like new fandangled secondary market came alive. Yeah, I mean, there's a lot of people that they'll just recycle capital. They have maybe $1, $2, $3, $4 million, and then they loan it out, and then they get to say, okay, you buy it over here, you buy it over here, and then you make a difference, or you make some sort of a spread. And that was one of the reasons that like we didn't have to stop lending, is because we actually have a balance sheet. We have participated in the secondary market. Our loans are in securitizations in some way, shape, or form, but in aggregate, we keep most of our loans. So although I did the exact same thing that everybody else was, but really I'm a child of 2008 too. Like I got killed in 2008. And my goal is to not lose money again. So we were very conservative for at least a couple months there because we just didn't know. But it was crazy to watch how divergent things were going to happen. Credit markets seized up, like Shreyas was saying. Like everybody was like, hold on, pause. We have no idea what this is going to do to us. And as I'm watching the Northwest MLS, because I'm in the Northwest, and it's like interest rates are coming back down as the Fed comes in. Financial aid is coming in. Unemployment, all this other fun stuff, and all of a sudden, there's urban sprawl is a real thing. It's crazy to watch. It was, going through 2008 was fun, but not so fun. This one's going to be this is one for the record books as well.
Oh yeah, and we don't even know the full effect yet of what's really going to happen.
Well, that's the crazy thing. Here we are 5-6 months in, and most of the credit markets are back to quote unquote normal. And in typical times, we're seeing forbearances these days somewhere in the 7 to 10% range, depending on the type of lender. And in normal times, a forbearance rate of 7, 8, 9, 10% would be, I mean, all hell breaking loose, the world panicking. And yet, for the most part, most of the lenders that I see are kind of back to business as usual. And a lot of that stems from the fact that over the last 6 months, I mean, the Fed has printed trillions of dollars. A lot of that have gone into small, medium, and large businesses. On the employee, the W-2 side, I mean, a lot of people are being propped up by unemployment bumps and a lot of money rolling into unemployment, both from the federal side and the state side, as well as direct stimulus to consumers, that $1,200. And you kind of couple that with the fact that business and industry was shut down for a few months, so people weren't spending money, and the savings rate skyrocketed for a few months. And for the first time in decades, a lot of people were finally financially secure. They had enough money to support themselves for a couple months. And now everything looks like it's back on track. Everything looks great. The stock market looks good. The equity markets look good. The credit markets look decent. It seems like foreclosures are still relatively low. Evictions are low, obviously, because there's a moratorium. So if you kind of just look on the surface, everything kind of looks okay. But what happens when the government stops printing money, and what happens when forbearances end, and when the eviction moratoriums end? And it's kind of, there could be a confluence of just lots of negative impact, especially on people that were living paycheck to paycheck or worse a few months ago, and things could get really bad. So yeah, things right now, I think we're kind of in what I like to refer to as kind of the eye of the hurricane, where everything kind of seems nice and normal and calmed down, but something big could be coming along.
Dun, dun.
The dam wall is just growing higher and higher, and we're just pumping more water and more water into it.
Let's talk about that. We're definitely going to dig into some of the more fine-tuning aspects of funding and raising capital throughout this chat. We'll get into like, hey, if I've never done a deal before, how do I raise capital, or how do I fund my deal, or if I want to scale up, what do I do there? Best practices. So we're definitely going to get into that for sure. But I like to talk a little bit more globally right now in the beginning for like some education purposes. So interest rates, let's talk about that. So right now, the Fed has basically said rates are low and they're going to stay low. So what the heck does that mean? Like, is that like, should we all be celebrating and buying Ferraris and taking cash out refis and living it up, or like as an investor, is this a good thing or a bad thing right now that rates are so low?
Oh,
What do you think? What do you think, Fred?
that's a tough one to answer. So, I mean, interest rates in the Fed is kind of different and, and somewhat decoupled from, interest rates that, we talk about for our refinances. Right now the Fed is doing things to arbitrarily, stimulate and keep the credit markets going in the overall mortgage market, which, buying in the 2% coupon rate, going up to interest rates of 2.5% and 3%. My mother-in-law just locked a 2.5% on a 30-year fixed loan. I was like, what the heck? This is like almost free money. And the Fed is, basically committed to, staying in the game for a long period of time until inflation is above 2%. Dude, I mean, it's, right now, I think it's probably what we need. I think long term, there's some unintended consequences that may or may not come from it, but dude, who knows?
I guess the key word is there. Is it unintended or is it intended? But that's, I'm not going to get into that. But there's basic economics though. Like if you keep the rates as low as they're going to be for so long, what traditionally happens to the economy?
I mean, hopefully it's going to stimulate and grow. Hopefully it's going to, put a lot more money in people's pockets, provide a greater savings rate, and just inject liquidity across the markets all over the place. I don't know. Right now, it's really kind of interesting because there's the gap between the haves and the have-nots, and I think that right now it's just getting bigger and bigger and bigger and bigger, which is probably it's what the Fed has in his tool belt to be able to deal with, but it may or may not be an unintended consequence of what continues to happen.
Right.
Go ahead.
Oh, just adding to that. I mean, agree with everything. The Fed has, as Fred was saying, whatever the Fed sets generally flows through to interest rates that you experience. So it's not like what they set. There's a one-to-one correlation with what you pay. Although there's two things. One is it can't be lowered. There's no farther to go really. So we're kind of at the limits of what we can do through interest rates. Then kind of Tarl, to one of the things you were mentioning, there's generally an inverse correlation between interest rates and inflation. So the idea is like, you got to manage these things because you keep rates low to stimulate, people taking money out, making investments in businesses, spending money, and generally growing the economy. So like, if I'm a business that doesn't invest in a plant, then that's jobs that are lost in the future, both to build it and then people who can work there. And so the Fed wants to avoid people saying, businesses and individuals saying, we're just going to sit on the sideline until we figure this out. They're going to try to make it as attractive as possible to borrow money. The problem with that is it's generally going to push up inflation. And the Fed's, one of their primary objectives is to manage inflation to that 2% range that Fred was talking about. And so, Fed has said this is going to be the policy for at least several years, and it's irrespective of inflation getting slightly above where we'd like it to be. And so I think they're sending as clear a message as they can that we're committed to this strategy, and even if we absorb a little bit of excess inflation.
So that like on one side, I mean, to circle back, and I understand what you're saying, Shreyas, is and similar to what you just said, Fred, about how this. I believe what you just said, Fred, which is the haves and the haves nots keeping down this path continue to get bigger and bigger and bigger gap, like in that situation, especially if inflation continues to go up, and if it does go up like they project. And if you own real estate, that's awesome, right? But if you don't, like then, and you have no hard assets, which most of the US people just have absolutely horrible financial education, which, there's a lot of reasons for that. And it's just going to get worse and worse and worse, in my opinion, because of that. And it's going to piss off a lot of people, but they're not going to realize that what's really going on. That's the sad thing, is that we're the evil investors, so it's our fault. But it's, I don't know, like that stuff upsets me quite a bit.
Yeah.
Here's a couple things to keep in mind. One, the Fed came out last week and basically said, historically, and when I say historically, I mean the last 10 years, the target for inflation in this country has been about 2%. The Fed has said we want 2% inflation, and just understand why that is. Not having inflation is bad. It's good for us as consumers. Prices aren't going up. In fact, if prices go down, that's great. We can buy more, but it tends to be really bad for businesses. Because when the price of goods and services isn't increasing, businesses are making less money. And when businesses are making less money, they hire fewer people, they buy less equipment, they buy fewer buildings, all that sort of stuff. And that's bad for the economy. So inflation is good because it helps businesses, which helps the economy, even if it hurts consumers a little bit. So historically, and again, over the last 10 years, the Fed has targeted 2% inflation. Last week, they came out, and what they actually said last week was, we're no longer targeting 2% inflation at any given point in time. We're targeting 2% average inflation over time, meaning over the next 5 years, 10 years, they didn't state a specific time period, but over some period of time into the future, they're targeting average 2% inflation. Based on the Fed's way of measuring things, and we could argue all day about whether this is true or not, but based on the Fed's way of measuring inflation, a metric called CPI, we've actually been less than 2% for the last several years. So when the Fed says we're targeting average 2% inflation, what they're saying is moving forward, we want higher than 2% inflation. So they didn't say that in a way that it registered for a lot of people, but basically what they're saying is we expect inflation at 2.5%, 3%, maybe even 3.5% over the next couple of years to get to that 2% average over a longer period of time. So I think what we're going to see is, I think we're going to see more inflation than typically what we've been targeting the last few years. And that says to me that the Fed is concerned. They're concerned about deflation. They're concerned about prices dropping, which is again bad for business. And so they're going to do whatever they can to get inflation even higher than what those historic targets have been. So I think it's not being talked about a lot, but I think the Fed, if you read between the lines, is actually concerned and is going to push inflation even more than what a lot of people think.
Totally. That's right. Go for it.
I don't know if I had the exact same take on that, but I could see the methodology coming out of that for sure. You know what I read, which was just a couple of different articles. It was anyway on his comments, but I could see it. That's crazy.
Yeah.
Typically, inflation doesn't spiral. If you can keep inflation from getting out of control for the most part, but deflation can spiral. And so I think the Fed is a lot more concerned about going into like a deflationary spiral, which is the common term, than they are about going into some inflation. Because typically, if you see inflation, there are things you can do to slow it down a lot faster, a lot easier than you can slow down deflation if that starts in earnest.
Nothing like a pandemic to cause some deflation.
Exactly.
Yeah.
Exactly.
So on that note, like if you're an investor right now and you have a couple of houses or whatever it might be, or even your personal residence, like, is there any advice we can give to investors that might be like, hey, be a good idea to do maybe X, Y, Z right now because of what's going on, and especially on the funding side because of what you just said, Jay, and everybody else?
Yeah, if you believe inflation's coming, real estate tends to be a great hedge against inflation because as prices go up, so do rents and so do values of property. But even bigger than that, debt is probably the single best hedge against inflation because you're paying off your debt with cheaper dollars. So if you're making twice as much money next year because of inflation, well, your debt hasn't increased twice as much. Your debt's the same as it was today. So if you make twice as much, but your mortgage payment's the same, you're basically saving a ton of money.
Yeah. I mean, if we're doing a bunch of cash outs right now for some of our rentals, because we do, for those of you guys that are listening too, I do mostly single family BRRRR. So for us, we're taking cash outs and we're getting 3.5% on a cash out refinance on a single family investment property, right? 30-year fixed. And I'm looking at this going like, this is cheap freaking money, like big time. So what you're saying is that if I'm taking that cash out, locking it at 3.5%, then if inflation happens, then it's a good thing I took out that money at that time at that debt. Is that what you're trying to say? Or
yeah, I mean, imagine this year you take out, you make $100,000 this year, and you take out, and your mortgage payment is $1,000 a month. 1% of your income is going to pay your mortgage payment. inflation goes out of control and next year you're making $200,000, well, you still have $1,000 mortgage payment. So now 0.5% of your income is being used each month to pay your debt. If inflation increases more and you're making $500,000 next year, well, then a fifth of a percent. And so basically the inflation gives you more money to pay down the same loan, the same debt.
What does that mean? Like, so I grew up super broke, like, and I don't want to spend a lot of time on this part just because we got to get into some funding stuff too. But this is, I mean, like, as far as how to actually go about, doing this for, if you're watching this, but like I grew up broke, and a number of people in my family are still in similar circumstances. And if I know us, like if this was happening when I was a kid, like we're screwed, like big time. And in my opinion, with what's happening, like especially if inflation's going up, we didn't own a house, like nothing, like we were less than paycheck to paycheck. What about people in those circumstances with what's happening in the economy? Or is it just like leave them in the dust and let's go buy a bunch of real estate? That's a bigger economic conversation, right? So
yeah, just
what's your personal opinion? Tell me right now.
Just touch one tiny slice of that. I think, the challenge with low rates is that there's no real return to savings. So I think you have people who are putting money into the stock market and hoping it continues to rise as it does. And that's a strategy that works until it doesn't. And as a retail investor, you're going to be the last person to know about those kinds of things. So I'd have a little bit of, if you have money, it's like, what are you supposed to put it in? I actually think like real estate is a pretty solid place if you have a strategy. I personally wouldn't worry as much about inflation because I think America is just going to manage it very aggressively. We're not going to get into a regime where it's in the high single digit, double digit, where it can really get out of hand to where you lose faith in the economy. I guess there's not too much I would change except like this point that, if now is a really, really absurdly good time to be, borrowing money to put to productive use is what I would say.
Productive use.
Yeah.
That's the key. I know a few people that got that PPP loan and did not use it for productive use.
Yeah, that's only there's the moral hazard part, right? If you're taking cash out and you're going to go buy a Ferrari or whatnot, like, yeah, that's probably not the best. But if you take that cash out and you actually do something, good with it, absolutely. And I love it.
Everybody will do because we all have strong financial backgrounds and understand businesses really well. Because that's why our businesses didn't fail maybe when the market crashed in some capacity back in March and April. So, but that's not going to happen. Everybody's taking advantage of this crap. So it's true, right? Look at most businesses' finances and stuff and people's finances. And let's shift gears. All right. So I'm a brand new investor right now. So like, I don't remember, I'm talking to also my friends right now for everybody watching. So to me, this is, we're just bullshitting, right? So, so you're a brand new investor, check, right? Everybody in that frame of mind. And you saw what happened in March and April. You're like, funding went away. Okay. But funding's back, right? So I want to buy a fix and flip. Let's think that simple. I want to buy a fix and flip. I've never done a house before, anything like that. Like, what are some good like advice that you can give to be able to like get funding for my first fix and flip? Like whether it's hard money or borrowing money from other people, or what's some good practices that we can discuss just even on that side? Actually, let's start with this. What's one thing not to do as a brand new investor if you want to go raise capital or get financing from a hard money lender?
Don't think that you're super cool and you know everything already. Oh man, I can't tell you how many times I've heard someone and he's like, he or she or they, like, hey, we got a contractor, we got this guy, we got that guy, we got $100,000. We are the best team ever. And they overlook so many details, and then some of them, they don't even know what the details are. And they think that they kind of know everything. And those are the people that fail. I say that, ask questions, listen to these podcasts, network really well and be humble.
So you're saying put your ego in check, right?
Yeah.
And I think so, like on a side note, that some of that, if they are fresh out of a seminar, sometimes they're like, I'm serious when I'm saying this, I'm not joking about this. Like you went through a boot camp of some sort, right? Or a seminar, and you are jacked up. Like, this is how you do it. And you walk out with extreme confidence. Like, yeah, this is exactly how to do it. I would advise those people say, okay, so you've done it, just like ego in check, be humble. That's great what Fred just said. I think that's awesome advice, because you'll learn. Because I know a company like, I know Fred's company, like they'll even show you how to do it right. Like if you kind of like are messing it up, or like looking at like, you should maybe look at it this way instead, and accept that advice a little bit, right? Okay. What about Shreyas?
Yeah, I would say don't be over optimistic about your numbers. I think for a new investor, maybe it's tempting to go, I could achieve this. I could do it for this little. I'm paying a great price for it. And again, this is advice you hear in lots of forums, but seek like expert opinion on like, do you believe my numbers? Talk to active real estate agents in the market and figure out if what you think your exit is achievable. Is there enough margin of safety built in? There's this Warren Buffett story, I can't remember from what book, about how he keeps a card with like 20 slots in it. And he's like, these are the total number of investments I'm going to make, big decisions I'm going to make over the course of my career. And the goal is to avoid like the really bad ones. And I think if you're itching to just like play a hand in a transaction, that's probably something I'd advise against. Is like really, really like, you have to be like, you can tell Fred you like the deal, but you have to actually like it yourself, because you're the one who has to get to the other side.
Yeah, you're the one signing the personal guarantee.
Yeah.
So I guess part of that too is just like, don't be in a position that you have to buy a deal, or you're emotionally involved to want to buy it. I think I heard that as well as what you were saying too. And to avoid the bad decisions, because maybe their knee-jerk reaction into it, it's the best deal ever that anybody's ever going to have. And it might be, right? But it's better if your emotions are in check in that, right?
Yeah, totally.
I think emotions are always involved in one way, shape, or form. It's your first deal. It's like your first apple. You're like, yes. If the first person tells you it's crappy, okay, they have a slanted view. If the second person tells you it's crappy, like, don't do it. That's I've seen so much of that happen.
They just don't see it though, Fred. Like,
yeah, I know they don't. Believe me, dude. I have been there. I have done it. It's not fun.
So how do you handle where you have a investor that wants to buy a house and they go and you look at the comparables, right? And the comparables are off. Let's say they think it's worth 500 and you're saying it's worth 450. How do you handle that? Because I'm sure that's something that's probably going on right now a lot. And as coming for both you guys on the perspective of the lender, right? And even Jay, I know you lend private capital sometimes. Everybody hit up Jay if you ever need to borrow lots of money. Joking, don't do that. But that said, like, how do you handle, like, if you have a comparable issue where you think the ARV is one thing after repair value and they think it's another? Ready to go.
Who's going? I think for a lender, the discipline of being a good lender is that you have to have you have to understand the margin of safety on the loans that you make, because you're like, we can talk about this, but you're not equity participating, so you're not benefiting in the upside, so you definitely need downside protection. You can't have both those things as a borrower. So if you're so I think most lenders are going to really care about getting in sync on what the asset's worth and what they're lending against. And I think every firm's a little different in how they approach, like, well, I think it's this, and our internal number is something else, or we got a third party value and they came in. But I think most people who do this, I guess I can't speak to people on their very first transaction, but I feel like most people who are experienced, this is not a really big problem to resolve.
Every deal I do, which I can't flip that many houses, especially sitting in my theater from here, but I do a few here and there, and every time I ask someone else. I ask, I have an underwriting team, so I ask my underwriting team, like, hey, what do you think about this? Is this a deal or not? Because whenever you buy, there's always some sort of emotional component to it all. I'm sure you probably do something like this too. It's like, hey, I really like this house, man, it's really nice, but is this a good deal? And when we talk about it, we usually give them our comparables. We say, hey, these are our comparables. What are different about the comparables that we see versus the ones that you see? And a lot of times, you know, it's like they'll take a comp from like the other side of a freeway. And, you know, if you're a national lender, you don't necessarily know that there's like a big difference from street to street, or from like, you know, there's one area that's good and one area that's not. You know, now with Street View, you can kind of do a little bit more of that. But a lot of times I see comps from other places that are just really far away. It's like 2.5 miles away. Like, hold on, that's in Lakewood, and, you know, this is in like, you know, whatever, North
University Place, which
yeah,
if you're not
like,
from the area, you have no idea what that means.
Yeah, and you're like, hold on a second, like those two are not comparable. Like one peer, you want to live in one, you don't want to live in another. So a lot of times, you know, we take a really, really like, you know, not a concierge approach, but, you know, we want to get into the deal. Like our mission statement is real and lasting mutual success. I beat it to death with all of my people, and we make sure that the transaction is going to work for them, so it works for us. And so we keep doing it over and over and over again. And like, we're lenders, we want to make loans. It's not like we don't like you. We want to do the deal, but we want to do deals that make sense for you, so you can come back and we can do it again and again.
Yeah. And building on that, I think what a lot of lenders would tell you is they'll tell you if they don't think it's a good deal for you. And, you know, don't take that as, I mean, you can use that to say, well, you're wrong and I'm going to prove you right. But in general, they're coming from a place of like, we can make the loan here at this LTV, but we'd actually like you to come out the other side of this successfully.
So, something that like, and I advise, what you guys are saying is like spot on, and something that I've advised over the year. I did this personally, right? Which was, if I had a deal, I would send it to hard money lenders to evaluate it for me, right? So like I did that all, especially when I was new to Seattle area. And because if I couldn't get like, you know, a company like Fred's or whatever to say, yeah, it's a good deal, then I wouldn't buy it, like, period. But I would advise, there's some national lenders out there that just have no clue about your market. So just keep that in line if you're going to go down that tactic, and that you're using potentially somebody that knows your market, right? So they can give you the right advice. But it's true. Like if you send it to two different hard money lenders and both hard money lenders are like, yeah, we're not touching that. That should be a cue, right?
Should
yeah,
be, right?
I actually, I'm on the advisory board of a relatively large crowdfunding company, and we lend nationwide. And I'll be the first to say we have boots on the ground in most of the markets where we lend. But even those that are doing the underwriting locally in those markets probably don't know the markets as well as local hard money lenders. So I'm not telling people not to use crowdfunding. I'm a big fan of the site that I'm part of. But local hard money lenders are a tremendous resource. And if a local lender, if somebody wants to do a deal with me, if I'm lending personally to somebody, if I tell you that I'm not going to lend on it, it probably means it's not that good of a deal. Because my criteria for lending is I look at the deal and say, how am I going to feel if I have to take this deal over? Are the numbers good enough that I'd be willing to do the deal? And if the answer is no, I'm not going to lend on it, that gives a lot of information. So anybody out there who thinks I'm going to, like I think it was Fred that said, hey, I'm going to go prove them wrong. Yeah, I mean, that's nice, but it's probably not a good long-term strategy.
Love it.
The flip side is I've also lost some money. I've made some bets about what ARVs would be. And, you know, I've had to actually pay my fair share just because I've been wrong or conservative. But
quick, what's the most everybody's lost on a deal? $86,900 right here on one.
52,000. Only deal I've lost to him, 52,000.
So I got two monsters. My first one was 90. Other one was 380.
Ooh, wow.
And there's no partners on those things. I just got kicked in the nuts.
And Shreyas just prints money, so he never loses.
No, yeah, I've only done startup equity investing, so I've yet to lose money in real estate.
There you go. Good. So stay out of it. It's dangerous. All right, so let's talk about, like, let's shift gears now for the listeners as well, that and viewers. I'm an investor that's maybe doing this for a little bit, right? But I don't have the liquidity that I need to buy lots of deals, right? Because let's face it, you know, if you go to the traditional route, use a hard money lender, most hard money lenders require 20% down. Some are out there require 10% down. But you know, if you're in a market like, well, Shreyas' market in the Bay Area, our market in Seattle, I mean, like, that's a $700,000 house, right? And all of a sudden you need 70 grand if it's 10% or 140,000 down if it's, you know, 20%. That doesn't include rehab. That doesn't include unless you get it funded. That doesn't include your interest payments, all that kind of stuff, which is $7,000 a month if it's 12%. So all that kind of stuff kind of comes in. So how many deals can you actually buy if you constantly have to put 10 or 20% down, right? So what advice or what kind of tactics or strategies would we advise? And I know what I've done, and I'll explain that later, but if you wanted to go from only being able to do one deal at a time to be able to do 3 or 4 at a time or more, what are some traditional ways to be able to get that capital to actually like buy more than one deal? Jay.
Well, there's 2 main ways. There's debt and there's equity. Debt basically means you are borrowing money. So you're on the hook for the deal. You take the wins, you take the losses, but you are paying some percentage of whatever you're borrowing on a monthly or quarterly basis or whatever basis. But the lender, in theory, doesn't have risk. You're taking all the risk. The other way is an equity partner.
But that could be, sorry, that lender could be a private person. That can be.
Absolutely. It could be your family. It could be your friends. It could be a hard money lender. It could be a small bank. It could be a big bank. It could be anybody.
So should I take the $50K from my uncle's 401k that he's been saving up for years and use that to invest in real estate?
How much do you like your uncle? Yeah. So, and that's part of it. I mean, you have to do that analysis. So as professional lenders, and I'm not a professional lender, I know Fred and Shreyas are, as professional lenders, part of their model is they are going to take losses, but they know how to do underwriting, and they know the risks, and they know the business, and they diversify over tens or hundreds or thousands of loans. So that's part of their model. Your uncle is probably doing one deal. He doesn't know how to underwrite it, and he's putting his faith in you, and you're going to have to see him every Thanksgiving or Christmas. So you have to ask yourself, is it worth it to have to sit down to Christmas dinner with my uncle every year and have him and everybody else know that you borrowed $50,000 and didn't pay it back? And that's the calculus each of us has to do when borrowing from friends or family or anybody that's not a professional lender.
Love it. So what's the second way?
So the second way, and I don't want to hog all the time. If Fred or Shreyas want to talk about equity, feel free.
Just ignore them. Just ignore us. It's cool. Don't worry.
It's just me and you right now. It's all good. I'll turn the
okay. And so the other way is an equity partner, and that's somebody that comes in. They bring money just like a lender, but they're not a lender. They actually have equity in the deal. They're taking a risk, so they own some percentage of the deal. And let's pretend they come in as a 50-50 partner, but it could be any percentage. They're now entitled to 50% of the profits, or they are on the hook for 50% of the losses. They're bringing some percentage of the capital. So they're taking risk, and you're not paying them monthly. You're paying them in some percentage of the profits or some percentage of the losses. And the benefit. Say it again?
Like a joint venture.
It's basically a joint venture.
Yeah.
And there are pros and cons to both sides. I mean, a lot of times debt can be a lot cheaper. If you're going to make a lot of money on a deal, debt's a whole lot cheaper than equity. But if you're going to lose money on a deal, I'd rather have equity, somebody sharing in the losses. So there's pros and cons for both, but basically every type of financing is going to fall into the category of either debt or equity.
I have a little personal history around borrowing money from family members.
Go for it.
I lost a little over $100,000 of my brother and his best friend growing up. I mean, the story ends well, but holy crap! Like I basically went broke trying to give him his money back. This is 2008, 2009, and it was all second loans that I did. So, for me personally, I never advise taking money from somebody unless like the deal is freaking amazing. And then you give them some upside too, and make sure that there's like, if you win, they win, and it's not just a one-sided thing. So everybody kind of builds a little happiness, but be careful with that one. And Rain City, at least for us sometimes, especially if they're like smoking deals, which we see, every once in a while. We have a line item on our P&L. It's called shared appreciation. And so we'll fund 100% of the deal. And again, this is very, very few, but we'll fund 100% of the transaction, take a percentage of the equity, so to speak, fund all the renovations, the operator or the sponsor, or whatever you want to call them, the borrower. They do all the work, and we split the upside. And there's been we have a few relationships that we did this in 2012, 13, and 14 that still work with us now, and they thank us, but they say, hey, we don't need you anymore.
I don't want to give you that equity anymore. Yeah. So there was a period of time when I was newer in the business, and we were slinging deals left and right during the REO phase. Like, if you guys are newer in the business, then there was a period of time not too long ago where deals were just flooding the streets everywhere, right? And you couldn't get funding for any of them. But that was during the REO foreclosure side. And, we were just doing so many that I was giving away 80% of the equity just to keep deals rolling. And we were only taking 20% just because we needed the funding. And it was actually harder to get the funding back, even just not that long ago. Like, you're talking like 6 to 8 years ago. And now I would be like, screw you, like, in so many ways, no way I'm doing that, right? But there comes a point where sometimes in your career, maybe you have to give 50% of it away, or, in my case, back in the day, 80% at times. And then you can just start shifting it and changing it from there. Debt, we use debt. I remember, I'll tell you what, my piece of advice on borrowing from people, is I would never, ever do it unless I knew that, one, they're going to leave me alone, right? And not bug me about it. 2, it's not all the money they got, right? 3, they can lose it, which they would never lose it with us. We would pay it. And that's the other part. I could pay it, right? Whether or not they, if we did lose it in some way, I could still pay it back. That's people I know. Everybody else, yeah, whatever. We'll lose all their money. Joking. I'm not gonna do that. So, but in reality though, like, it's really, really important to take care of people that you borrow money from that are not professional lenders. And you should still take care of your professional lenders, but you're dealing with people's livelihoods that are individuals and so forth. Like, so take that very, very seriously. And your reputation is everything the longer you're in this business. And if you're not careful with that kind of stuff, social media allows us to talk crap about so many people. And if you're taking advantage of people find out, like, and really, really fast. So be careful with that. But Shreyas, you got anything you want to add to that, or?
No, just, agreeing with everyone that, I would be real hesitant to take money from unsophisticated investors, like family members in particular. They have other reasons to put money in because they want to support you. And sometimes emotional support is better than financial support because it weighs on you if you can't repay that. Whether it's equity or debt, there are professionals you can get money from. And on the equity side, I use the term professionals loosely because, Charles, I remember the first time I went to one of your meetups when Charles and I flew up to Seattle, and I was just like blown away by how many people were there and how many people I met in one evening. And it's like, if you have a track record and you can't go to a forum like that and meet people who could help you finance like what you needed on an attractive transaction, you're probably doing something wrong. So I feel like it's there, so you shouldn't need to go to your uncle's 401k for it.
Totally. And if you are going to go down that route with dealing with actually anybody, literally anybody, it doesn't matter if it's a family member, neighbor, or like a professional investor that has lots and lots of money, always have something in writing, like, no matter what. And, definitely if you're borrowing debt, you need to have a debt. You have to have a note and deed of trust in place on the property, like if you're doing it right, and protecting that lender's money basically. And if it's a joint venture agreement, definitely have it in writing. I'm not going to name their name. They're probably listening to this either now or later, but somebody that I've been helping out a little bit as far as with their business. They did a joint venture agreement with somebody that's in their family, and it did not go very well, despite the fact I said get it all in writing, and he'll always remember to get it in writing. But now they have a bad relationship because they didn't have clearly outlined roles. You didn't have anything, like it was just everybody pissing each other off. And now, one of the family members hates the other family member because of a deal that made a lot of money, but they didn't get it in writing. So, and they will always now. And I know you're listening. So,
and always expect the worst case. I know some people who I would consider amazing investors who lost a fortune in 2008 and defaulted on a lot of debt. And so no one's to say that another 2008 couldn't happen again. And even some of the best investors out there are going to lose money. And so if you borrowed from your uncle, even if you think you're a great investor and it's a low risk investment, there is risk. So be conservative.
Love it. Okay, so let's go ask one of the questions from some of the viewers that are out there. Before we do that, though, all of you guys are going to be joining us at the Virtual Real Estate Wealth Expo happening September 18th and 19th. We have over 40 sessions happening at this, September 18th and 19th. Go to virtualwealthexpo.com or badassexpo.com, either one. Let us know how you found us as well when you buy your ticket. Ticket prices go up Friday. So Thursday is the last day you can get tickets at the discounted price right now. If you use discount code BP10, you will get 10% off. So do that now. Check it out. Full interactive networking. Super dope. We have Robert Kiyosaki as a keynote. Go to virtualwealthexpo.com or badassexpo.com. Takes you to the same place. And get your tickets before prices go up tomorrow.
Do it.
Do it. We're all going to be there. It's going to be great. You can network with all of us. And not some BS networking where you're just like in a chat room. I mean, like full on, like what we're doing right now, the four of us talking to each other. You can do that at our conference. Super cool. So that's it. Here we go. Let's ask this one. Since all of us but Jay are in expensive housing markets right now, Sean's asking, do you have any advice on how to fund buy and hold rentals in a high appreciation, low to negative cash flow area like the Bay Area, Seattle, SoCal, without sinking in 50% equity in the deal? I guess like without having, so basically I guess what maybe you're asking, Sean, is like, how do you cash flow on a property that like,
it's impossible to cash flow.
That's impossible to cash flow on. So like, you're on the right spot, Fred, from what I heard just now. So what you're saying is like, I have to put 50% down in order for it to cash flow, is what we're hearing, Sean. Do you guys have any advice on that? Because I have some that's not going to be happy for him.
Unless there's a good reason, don't buy it. We have a couple of clients that they're okay with longer term appreciation, but they have capital to deal with it, right? So they have committed capital, either 5 or 10 years, where they go and they buy these things for the zoning or the potential zoning changes or opportunity zones or whatever, which opportunity zones may or may not be in a higher ed district. But yeah, I mean, you kind of said an oxymoron there. You said cash flowing rentals, but you have to put 50% down because it's a negative cash flow. It's kind of like, I typically want to buy it for cash flow or longer-term appreciation. Well, I don't know.
Yeah, I mean, that's the fact is like there's people that buy in the Bay Area and Seattle markets and other high areas that aren't caring about cash flow as much, and they want the appreciation. I don't do that, and there's a lot of people that do though. But I guess I would say, I don't know if you guys advise on this, is that one of my good friends, John Nav, who invests in multiple states everywhere, just about 100 deals a year. He's like, you're not a tree, you don't have roots, right? You can buy in other places you don't live in. So especially if that's your investment criteria. So if you're looking for cash flow, then Bay Area, Seattle's not your market. So you gotta look elsewhere. Or you do what we do, which is BRRRR investing, but that's, even then, I'm not buying BRRRRs in downtown Seattle. So I'm buying them in other markets outside of that. But because cash flow is important to me. Shreyas, you got any advice?
Yeah, I was just going to add, I mean, maybe I'm an outlier here, but I would personally prefer some additional asset appreciation over cash flow. And I don't know if there's probably people like who are on a spectrum. So you just have to accept the fact that you're going to do, fewer, you're going to be in fewer transactions, and it's not going to like look as good month to month. But I think you need a really strong medium-term thesis around the market. Like if you were going to go after high cost appreciation markets, I would have a really strong point of view on why Seattle versus the Bay Area, or why the Bay Area versus Seattle. If you're just like, it's expensive and it's going to go up, it's like relative to what? I think you need to have a point of view on that.
I mean, even I didn't learn this until a couple of years ago, or actually last year when we did our first 1031, but like, maybe you go play in a different market that cash flows and you build up some equity, and then you 1031 into the more expensive areas. So that way you're putting, your down payment for that 50% or whatever's coming from appreciation on other properties and so forth. But that's one way to do it too. So I don't know. But anyways, okay. So next question. What are your opinions on the future of the housing market, given what the Fed has said about their plan with inflation? So we kind of talked about that briefly before earlier, but with the Fed's plan, what do we think that's going to do to the housing market?
Long term, I think it's good for housing. And when I say long term, 5-10 years. Now, next 6 months or 12 months or 18 months or 24 months, I think any of us, and I don't want to put words in anybody else's mouth, but I think it's probably safe to say any of us would be guessing if we said we knew what was going to happen in any market, in any place in this planet over the next 6, 12, 18, 24 months. Too many things that we just can't forecast. We don't know who's going to win the election and how that's going to impact things. We don't know what the Fed's going to do in terms of stimulus and how that's going to impact things. We don't know what the trade war. So, I mean, we don't even talk about the trade war anymore, but there's still major import-export issues worldwide. And so when we kind of get back to that as a topic of discussion, trade war could impact things tremendously. And then we just have things like, what's the economy going to look like? So are we going to see 8, 9, 10% unemployment over the next few months? Or are we going to see 15, 20, 25% unemployment? Are we going to see 20% of businesses not recover? Are we going to see 60% of businesses not recover? So I think all of these things will factor in, and nobody really knows. And at least I certainly don't know. But long term, I think the Fed is targeting inflation. The Fed typically gets what they want. And so long term, I think we're going to see at least 2% inflation, and that's going to be good for real estate long term.
That sums it up.
That's just my opinion, and I'm guessing it exactly. That's
an 8-ball.
Please don't anybody think that I know anything more than anybody else on this panel or anybody else on the planet. We're all just guessing.
Said it here. It's recorded. We'll watch this video 5 years from now.
If I'm right, it's because I'm brilliant. If I'm wrong, well,
it's because you're a genius.
Yeah. So either way, so everybody put your chips on Jay's number right there. We're good. So all right. Here's an easy one. Alex is asking, do you have any suggestions for creative strategies to navigate debt to income requirements in order to take advantage of the low interest rate financing that's out there?
Pay off any installment debt you have, cars, trucks, anything that hits a high payment. Stack your chips up and put it all there. That's like the number one thing that loan officers see, if the debt to income is really tight, or, try to jump your leases up. But, right now, COVID era, there's not a lot of people that are raising their rent significantly. They're just kind of happy that they're paying rent and staying on time. But yeah, installment debt and getting rid of whatever, a car or an ATV or whatever, try to figure out a way to get it out off your credit report. That's ideal.
Yeah, I would add that to clarify, Alex, are you asking about also investment property, or are you asking about your personal residence, right, for that as well? Because that also changes things a little bit as far as what you can do, because there's portfolio lenders out there that, like your local credit unions, that don't look at your debt to income ratio, right? They look at the property itself, and they look at your debt service ratio on the property. And that would be another way. You might not get a 3.5% from a conventional, but you might be able to get a 4.5 or something from a portfolio lender, depending on what it might be. That's out there. So it's also a different way. Your personal house, that's different. And so you do what Fred just said for sure for the debt to income. I do know that sometimes this happens too when you go to conventional. If you have like 8 Fannie Freddie loans on your credit report, and you go to the certain underwriters, certain underwriters don't do a good job measuring your debt to income ratio as an investor versus other underwriters too. Would you agree with that or disagree?
So certainly things like I've seen some underwriters not realize, hey, add back depreciation, things like that. So basically your income looks lower or different than what another underwriter may think it looks. So a lot of phantom write-offs that aren't necessarily added back.
Yeah, that was kind of a softball, like going like, if you just go to your local bank and walk inside and you're just dealing with the person at the front desk, like that's your loan officer, that might be the wrong bank to be dealing with to get a good conventional loan. I would recommend going to a mortgage company that they know how to look at your stuff as a real estate investor, and because their underwriters will understand how to read your tax returns better. And if you're like any real estate investor out there, forgive me, that's absolutely not true. If you're like most real estate investors out there, you have horrible tax returns. So go get that stuff fixed, and then and make them look cleaner and better for the underwriters to understand how to read them. There you go. So let's throw that out there too, just for especially house flippers. I'm talking to you. You know who you are. Fred knows. Shreyas knows, right? So
QuickBooks, man. QuickBooks.
Yeah. Well, Jay is the rarity that reconciles daily on his QuickBooks.
So I'm sitting here doing in the background.
Yes.
Exactly. All right. So
Bookkeeper.
now, if we were going to, let's say that for those people that, let's take it to another level. All right. So we talked about raising capital. You can do it with debt, right? Which is giving equity to other people like joint ventures, or you start an LLC together or whatever it might be. We don't want to go down the route of why you should or should not do that with maybe somebody. But you can do that. Or you borrow money from a private person, give them a private note, not a private note, a note or deed of trust on the property for an interest rate of some sort, right? What are some other ways people raise capital outside of that? And what should we advise people that they should maybe start a fund, or should they traditionally maybe do the private capital where they're raising for the actual single family home itself, or the multifamily, or do joint ventures? Like, I know some of you guys. Oh, Fred, I know you've done this. Like you've raised money for a fund before, right? So is there any advice for somebody that wants to start raising capital, just to have a fund to start buying a bunch of properties?
Well, if anybody tells you that it's going to be less than $5,000 or $10,000, just stop there and go somewhere else.
Are you talking about like to start a fund?
Yeah, just to start it. Because I mean, if you got to go to someone that actually knows securities law. I remember the first time that I put my PPM together. This is a long time ago, but attorney's like $7,000, and then I got it. And you know, the first real investor that I put in from, he's like, "What is this dog shit? See you later." I was like, "Oh, okay. I should probably go get a real attorney." So I did that, and you know, I think nowadays, and I think it ranges pretty significantly, but it's 20 to 30 grand. So just know that going into it, it's got to be worth it. And you have to be able to, kind of run your numbers and know the economics about what you're doing and how you're doing it. If you're raising money to flip a house or raising money to flip multiple houses, like if it's one house, you don't really want to go through that. But if it's multiple houses and you have the infrastructure to do it, and then you can. But just know going into it, it's going to be expensive. You got to put an outlay out there of anywhere from 20 to 50 grand for something reasonable and something that's marketable. But then know your numbers, like you really, the reason why I was able to raise money is because I had, 4 or 5 years of operating history. And, I was also raising money in a really, really bad time. There wasn't like money flying around like it is right now. It was like, okay, getting a couple $100,000 at a time was a little bit tough. So know your numbers, know your market, and know what your expected returns are. And structure is extremely important too. I could talk a whole hour and a half around structure, different structures, promotes and preferred returns and waterfalls and also the craziness that
which you might be getting into that at the Virtual Wealth Expo happening September 18th and 19th, right? On top of your, if you guys go to our website, virtualwealthexpo.com, and go to the agenda, you'll see Fred's topic on there right now, which is literally says how to be a baller 101 and 102 at this time. So I'm really excited for that topic.
Yeah. Thank you very much, Carl. Thank you.
You're welcome.
It's probably worth stepping back also for anybody that's brand new to this whole raising money thing to define some terms. So just like Fred said, going and setting up a fund and getting a PPM, a private placement memorandum. A lot of people have the question, well, do I need that if I'm going to be raising money? And so and please don't, I'm not an attorney. And I'm not a tax advisor. So don't trust anything I'm saying, but general rules of thumb are, if you're raising money from a single person or a single entity to be used for a single property, and you're not raising any other money to be used for that property, you don't need to set up a fund. You don't need to get approval from the SEC. You don't have to worry about running afoul of SEC rules. If you want to borrow money from Taro or from a bank or from your uncle for a property, whether it's 50% of the cost or 100% of the cost or more, that's fine. You can do that. The time that the SEC and these other things come into play is when you are taking money from multiple people or multiple entities and you're putting them in a pile, and you're doling that money out in different places so that my money is indistinguishable from somebody else's money, which is indistinguishable from somebody else's money. So I can borrow money from Taro for property A and from Shreyas for property B and from Fred for property C, no issues. But if I want to take Taro and Fred and Shreyas's money and put it all in a pot and use that to buy these 3 properties indiscriminately, that's when the SEC is going to care and is going to get involved. So it's important to understand that, because a lot of people, they get confused on that real basic piece of it.
So Shreyas, you have plenty of experience raising private capital for companies, right, and startup and so forth, and VC money. And is there any similarities to that versus raising capital for a fund for real estate, or is it different?
I think there's a lot of similarities. I think one of the main similarities is that fundamentally the person you're raising money from has to deeply trust you as a counterparty, both to execute well and to have controls in place, because once the money is handed over, their level of oversight, even if they ask for a lot, is going to be really minimal. I think that if this is something you're interested in, like having the ability to pull funds together for projects or for long-lived entities, like the harder part, I think, is building the roster of people who trust you, who would put money into it. And then, as Fred said, it costs something to set these things up, and there are a lot of nuances to. I actually think in this regard, equity investing in companies is simpler, because the structures I've seen for real estate funds greatly vary in terms of like what happens after a preferred return gets hit, and then is there a catch up after that? And there's really a lot of maybe not an infinite universe of terms, but there are enough. But you can figure that stuff out, I think, if there are people who fundamentally want to invest in your business.
Mm-hmm. Okay. And this is a big topic, like a really big topic, but I guess the message we're getting here is if you want to start a fund, right, you should probably want to do it for lots of properties for one, or have a plan, have a structure. You know, you're going to spend 20 to 30 grand to set it up. So make sure it's worth it. There's nuances you got to follow. There's guidelines you got to follow, make sure it's worth it. And then have a business plan, a structure, a process, all that stuff. Cause you're basically starting almost like a business at that point. Actually, not basically, you are. And have a purpose for it, and then you can go do it, right? But if you're just doing it to figure it out, that might not be the best thing to do, right?
And also make sure that you have people that actually are planning to loan you money. It's like writing a book. So I've written a few books, and I have people come up to me all the time and say, I'm planning to write a book. And I'm like, okay, but make sure you have people out there that are ready to buy your book. And invariably they think, okay, once I write it and put it out there, people are going to start giving me money to buy my book. Well, it's the same thing with raising capital. First of all, people don't just go out and buy your book, and people aren't just going to give you money. So make sure you have people that are ready to give you money before you do it, and don't just expect that part's going to be easy once the fund is set up.
Yeah. Well, but I hear all the time though, dude, like just find the deal and the money will come, right? And I thought that's how this works.
And it's a lot easier to raise money for a particular deal than it is for a fund. If you come to me and you say, hey, I've got this deal, I can look at it and say the numbers work. And if I have to foreclose on it, I know what I'm getting in return and whether it's worth it or not. But if you say I'm raising money from my fund, I don't quite know what I'm going to invest it in yet. Then I'm just trusting that you're going to use that money wisely later. Because
there's certain companies out there that I definitely know in my local market that did not do a very good job with people's funds. So, but besides the point, don't be that person. We're going to keep going with some more questions and stuff. But before we do that, just because we got everybody's attention right now, Shreyas, how do people get a hold of you as well as like possibly your company and so forth if they want to hit you guys up for what you guys do?
Yeah, our Certain Lending, our website is certainlending.com. My email is Shreyas, my first name, at certainlending.com, Shreyas.
I think Charles, first name email that they should also have?
Charles at certainlending.com, also a good one. I think our toll-free number is 833-Shreyas, because Charles set it up that way because he's got a lot of free time. Yeah.
And then Fred, how do they get a hold of you and your company?
Fred at RainCityCapital.com and RainCityCapital.com.
Perfect. Right. And you can find out all about what they do by reaching out to them in some capacity. Now, let's jump into a little bit more for some questions. So Michelle actually has an interesting one, right? Which is, she's coming from Facebook right now. Isn't it better to borrow against your personal home and max it out at 2.5% and then use that money for rental properties? Or like everybody says no right now. I think that's the best way to do that with your personal home, isn't it? That's what she's asking. So do we have any, I'm going to hold my opinion to last, but Jay, what's your thoughts on that? You're muted. All right. So Shreyas, what's your thoughts on that?
I mean, Sorry, Jay, my personal, I think it's a valid strategy. I would prefer to not use my primary residence as a thing to tap into. So I would move in the other direction, but it makes sense mathematically.
Fred?
I just don't like the term maxing out. I'm all about good leverage, not crazy leverage or quote unquote maxing things out. I'm also the guy that pays a significant amount towards my principal balance on a monthly basis, only on my primary residence. So, but I'll also, like I said, I got my ass kicked in 2008. I don't want to do that again. So housing market goes to shit. I want to be able to sell my house and, at least get some money out of it tax free.
Fred, that is a fear-based mentality, and that is not what an entrepreneur needs to have right now.
Hey man,
correct.
You lose $1 million overnight, what it feels like, and that was all your money. You're gonna have a little, little angel on the side of your shoulder saying like, "Hey, don't do that shit."
Yeah, but look at you now. You have a disco ball as a backsplash behind you.
Yes, I do.
I think anytime somebody asks a question like this, you have to remember there's two answers. There's the mathematical answer. And mathematically speaking, certainly purely mathematically speaking, not taking risk into account, more leverage is going to generate higher returns if it's positive leverage. And if you can borrow at less than you're earning on whatever you put that money into, it's arbitrage. You're making money. So from a mathematical perspective, certainly borrow every penny you can and invest it and make more money. But as we've been talking about today, it doesn't always work out that way, and there are risks. And the question everybody needs to ask themselves, and I think this is even more important than the mathematic question, is how well do I sleep at night knowing that I have this money in this investment? And personally, I'm pretty conservative. I don't sleep well at night knowing that I'm highly leveraged. I can make a whole lot more money if I were leveraged at 80 or 90 or 100% of my portfolio, but I choose 60% as kind of my baseline number. And I sleep well at night knowing that for the most part, what I own free and clear can be used to pay off anything I have borrowed in a worst case scenario. And so I'm giving up some mathematical edge. I'm giving up some return to sleep better at night. And so everybody has to ask themselves what's going to help them sleep better at night and what their personal risk mentality is.
Couldn't agree more. I think it ultimately, Michelle and everybody else listening, it's a personal choice. And as long as, in my opinion, would be as long as your eyes wide open on that and you understand the risks involved and you're good with it, then that's why it's your property and that's why it's your decision and your finances. So go for it if that's what you want to do. Just like my big thing on anything is just know what you're doing. Like as far as like go into things eyes wide open. Like, all right, this is the risk. Let's measure it. I'm cool with that. And if you're cool with it, then who cares what we think? So
yeah, but I think Fred had a really good point, which is just like plan as if your home might be worth a little less in the future, and would you still do the same thing? Like it doesn't have to be 50% less, but just have some coverage.
Yeah, like me personally,
I'm okay with losing all of that money. If you're not okay with that answer, you probably shouldn't do it.
Yeah. So I would be, for me, my personal home has a lot of equity in it, and I don't tap into it like at all. So but that's me. I like to keep business very separate from my personal stuff as much as possible. And the last thing I want to do is tell my my family that we can't live here anymore. So, but that's because I am extremely pessimistic and paranoid of a lot of stuff. So, and but anyways, that's me. But rentals, yeah, let's leverage those things. Let's go. So we're good on that. All right. So another question. Thank you, Michelle, for that. All right. So let's wrap up with a fun story, right? Let's wrap up with a fun story. So Jay, you just got done with raising your first big syndication deal, right?
I did. I and other people. I didn't do it myself.
You told me the other day it was all you. So,
far from it.
Sidelines. So, but real quick before that though, Fred and Shreyas, have you guys done any syndications?
Nope. Not in the technical term or in what what Jay did. No, but I have.
So Jay's officially the expert on the panel. So All right. And since you did it all on your own, tell us more.
Yeah, so this was the first syndication. We raised 8.5 million. I raised a percentage of that 8.5 million, and we had several people that were raising. But my best piece of advice to anybody out there is to remember that real estate or business or anything you do in your professional life, you have to play the long game. And you start just because I couldn't have raised millions of dollars 12 years ago or 10 years ago or 8 years ago. But I've spent the last 10 or 12 years, actually a dozen years before that or 20 years before that in the business world, building these relationships and building trust and getting to know people and building a strong reputation. And here we are years, decades later, and it's become very easy to raise money because people know that I'm trustworthy. They know my reputation. They can talk to other people who have loaned me money or who I've worked with. And so my biggest piece of advice to anybody out there that's thinking about raising, don't think about it from, I need money today. Think about it from the perspective of building relationships so that when you need money in a year or 5 years or 10 years or 20 years, it's going to be there.
Love that advice, because I get asked all the time, like, how do I raise private capital and stuff? I'm like, well, it's through relationships. And too many people scramble last minute to try to build those relationships because they need the money now. So, but what if somebody doesn't have any relationships right now? Like, what kind of advice can we give them?
This business is about relationships. Start building relationships. If you have zero relationships, then you're going to have to go to a professional lender. You're going to have to work with somebody who doesn't care, not they don't care, but who is underwriting the deal and not the person. When you raise money into a fund or in a syndication, people are typically underwriting not just the deal, but they're underwriting you as the money raiser. They have to trust that you're going to be able to operate, because a lot of times for these large deals, it's outside the scope of the ability for the investor to underwrite. I've raised money from people that aren't in real estate. So they don't know, they look at a $20 million apartment complex and they don't know a good deal from a bad deal. If I were flipping a house, they wouldn't know a good deal from a bad deal. So they're as much underwriting me and having to trust me as they are underwriting the deal and knowing it's a good deal. And so you want to get to the point where people are investing in you. There are people that I invest in that I don't even ask them. I mean, I've been investing with Brandon Turner for a dozen years now, before people knew who Brandon Turner was. And we're at the point where if Brandon needs money, he comes to me. I don't even ask him about the deal. Because I know Brandon's reputation. I've worked with him, and there are people that do the same thing with me. And you want to get to that point where basically your character is unimpeachable, where nobody ever has to question whether you're going to do the right thing with their money. And that takes time. And until you get to that point with people, well, you're going to have to work with more professional lenders that are charging higher rates and underwriting your deal. And it's really that simple. I don't know any magic bullet.
Yeah, I mean, for me, and I one thing that I really love is hustle. And I've made some investments in folks where I'm like, you know what, these probably aren't the best, but man, I love their hustle. They're working hard. They're trying to do something for themselves. They're trying to build those relationships. So that's always kind of the number one. But for me, I was on the flip side of that. It was 6 or 7 years ago. I needed more money. So I got introduced to these guys. The next thing I do is I fly down there with a couple of loan files, say, hey, will you give me money to fund these things? I sat in there and got interrogated for like 6 hours. And fast forward 6 or 7 years or however long it's been, if I said, hey, I need $1 million today, will you wire it into my account? They would say like, sure, sounds good. And that stuff took a really long time to do. And I've also just made them crap tons of money too. So that's helpful. But it started out with a plane flight and me putting on the dog and pony show to today where they trust me. So relationships are everything.
I also would, I think I 1000% believe relationships are everything in this business. And I would say this too, like for those of you guys that are introverted, that don't, like people or something like that, that might be okay because you can't actually outsource, relationships. So that's one. What I mean by that, you can maybe hire somebody that's better at it than you, but that's besides the point.
Actually, I think introverted people tend to do better because they tend to be more authentic. I'm not a sales guy. I find it very hard to ask anybody for money. And so I think there's that authentic. People don't like the hard sell. And so just because you're introverted doesn't mean you can't raise money, because you're probably just as good at building relationships, and you're probably going to scare off fewer people. So don't just because you're introverted, don't think you can't raise money.
Yeah, but Shreyas is like the most extroverted person I know.
Oh no, both hands up. Both hands were up. You can see it.
You are the only extroverted person on this panel.
That's right. I'd be like, Shreyas is, no, that's not, I'm not even an extrovert. I'm actually on the balance, right? I prefer to be alone. So
yep.
This is a professional extrovert right here you're talking to. But naturally, I'm like, leave me alone. But so that's my big thing. But anyways, all right, so cool. Relationships are everything. That's important. We like that. I love that. And if you guys need to build relationships, definitely start doing that now, because it's true what Fred just said, is that those are long-term payoffs, like especially if you're doing the right thing. That didn't just happen because he met with them one time, though. Like, you nurture those relationships, you build those relationships, you do the right thing, you pay them their money back with returns, right? That kind of thing as well. That's important.
Oh, don't get me wrong. I was their bitch for a couple of years.
Yeah.
Hey, Fred, will you go sweep the lawn? For sure. Why are you sweeping the lawn? I don't know. They told me.
So maybe you got to do that. I don't know. So, but it is important. And then one day you can just make that phone call and it's there when you need it, right? And it is a long game. It is a long game. So there's too many seminars and books out there. Nobody sells a book or a seminar that says how to become highly successful in real estate in 20 years or less, right? So it takes time, right? So deal with it. Any last thoughts you guys have before we sign off?
Fun times, man.
Fun times. Shreyas, how do they get a hold of you again?
Oh yeah, Shreyas at certainlending.com.
Certainlending.com. Mr. Fred Ray?
Fred at raincitycapital.com.
And of course, Mr. J. Scott.
Jay at jscott.com or jscott.com or...
No, jscott.com has a website.
I paid a lot of money for that.
A J and then the Scott.
Yep.
You get thetarl.com.
The Tarl. I actually have fredray.com. I've never put anything on it.
Yeah, it's a good idea.
It's still good to have.
Yeah.
You can follow me at Tarl Yarber on Instagram. I just went over 5,000 followers. Woo!
Woo!
I don't know what that means, but I feel excited. So you can follow me on Instagram. You can also reach out to us at any time at Tarl at Fixated Events, and you can also see us at the Virtual Wealth Expo. Check it out. It's happening next week. 40 plus sessions, whole massive amount of networking, thousands of people to talk to. It's going to be super freaking awesome. And all these guys are going to be there. So we will see you there. Bye.
Goodbye. See you guys.
See you guys.